Hello, welcome. This is SmartHelping.com financial model overview, and this is a plumbing business 10-year model, financial model for financial planning. I got a lot of really nice specific logic in here for forecasting the revenues and expenses for a plumbing business, and we'll get into it. I'll jump right in. Let's just start with the Global Controls tab at the top. First tab. Here you can define the company name, the launch year, end month, exit month, or this is just when the model will stop the forecast, and it's up to a 10-year period by month. Um, you can choose if you want to include a terminal value or not, and if so, it'll do a exit value based on a EBITDA multiple 12 month trailing. You can also define if you're going to fund any of the startup costs with debt, and the main output of the model is this equity required, which is based on all startup costs and burn. Basically takes the minimum cash position and puts it right here. Investment equity, investor and owner equity comes from the cap table, and then you can put in some tax rates here, and that will apply on the income statement. Here's the main thing, revenue assumptions. So for a plumbing business, and this could honestly be used for an electrician business as well, but the idea is, you've got plumbers that go out and do a job. The plumbing company, charges some flat fee for that job, and then they pay their plumbers an hourly rate. So this lets you, and I did some research on the different tiers of service. There's 3 tiers for a plumbing business, and as you go up, it gets more advanced. So each tier is structured the exact same way though. You can define the start month of the tier, the starting job count that you're doing per month across the whole company, and then the percentage increase per month in job count. So this means month one of you go with 50, then in month two it's 3% more, and et cetera, and it goes up 3% every month, and you could change that by year. And it's not, all these numbers are arbitrary. You can enter your own assumptions in all the light yellow cells across the model um, based on your strategy and what you think is feasible in your area or your strategic plan. Then you've got average ticket value. So this is every job on average what you're charging for this type of service. And it's just an average. There's obviously going to be a lot of different values here, but you can do an average. You can define the average hours it takes to do this job, and then you could define how many jobs on average a plumber is doing per month. So that's how you're scaling. The scale factor is the jobs per month, and then based on how many jobs a given plumber can do per month, and the hours it takes, that's how you're going to scale up. And then here we've got ancillary calculations. So you can see when you change the assumptions, you can see, look, if in this case, annual jobs complete is 573. Let's say if we started at 10 instead of 50, that goes down. Average hours per plumber is just a multiplication problem, taking the average jobs per month per plumber times the average hours required per job. So this is how many hours each plumber is working. Average monthly earnings. This is going to come from based on the expense assumptions, hourly rate earned by the plumbers, and there's also an increase um, in the jobs over time, and these assumptions here would adjust and change. Let's say this was 5. You can see now $5,000 a month per plumber because they're doing more hours. And then you've got total plumber count, head count, uh, truck count for the tier, and so this is based on the jobs. Now if we go back up to say 50, and you're doing each plumber's doing 50 jobs a month, you only have 1 plumber here, 2, then up to 3. And don't worry, decimals are completely fine. It's actually more accurate with financial forecasting because it's the probability of a value. And then you get up to 30 plumbers here for tier 1 service type in year 10. So these are all adjustable. You can also define the working days per month, which is just going to be an input to figure out on average, how many hours in a given work day, are your plumbers working. So these are some nice configurations. It's good to basically sanity check your own assumptions to see what you're putting in is feasible and makes sense. And so again, that works the same for tier 1, tier 2, and tier 3 services. And I put descriptions in the source where I got that information about the tiers. Um, So that's where you're driving and scaling revenue. Now with the expenses, like I said, we have an hourly rate for the plumbers, what they're paid. These are also some variable costs. All these are variable based on, so this is average equipment cost for the job. So this is going to be based on jobs completed times this amount. It needs to be like parts, accessories, anything you need to use to complete the job. Pipes, materials for sticking the pipes together, all that kind of thing. Then you've got variable cost per plumber per month. So this is just a filler to maybe some kind of perks or just whatever variable costs they're going to scale with the plumber count over time, and it's a monthly cost. You've also got monthly insurance per truck, which is going to obviously scale again with the counts based on your revenue assumptions. And then you've got average monthly maintenance per truck, and again, that's going to scale. So I try to capture the high level items that scale with your business for variable costs. And then this is kind of this other variable cost, I guess you could think of it as a filler for anything else you're not accounting for in these two items. We've also got payroll taxes for tier 1, 2, and 3, payroll taxes and benefits, which might vary between the three. And then you could define if you have credit card fees based on a percentage of revenue that's paid with a credit card. So that's variable cost. Then we've got fixed costs. These are just cost to run the company. So you're going to have sales and marketing costs if you're going to scale out the plumbing business. Different costs here you can define. These are just arbitrary. You can define the start month and the monthly cost of each one over time. And then G&A, same deal, just different cost category, but same setup. These would be things like maybe accounting fees, legal, managers, different fixed costs to just keep the company running. Okay, cap table. So this is to define, so this 1.7 is the minimum equity required to fund the company, which it might have changed when I changed the revenue, this number to 50. I can't remember what it was when I first started the model, but it's dynamic. So say you need 1.7 million to keep the company off the ground. Here you can define where you're getting that money from, outside investors versus inside, and you can define the share type of each common class A and B. If you have it, you probably just have common shares. So if you don't use any of these, you can zero these out, and that's fine. And then it'll go to fully diluted ownership share, and that will flow through to distributions and contributions, as well as internal rate of return of each row. CapEx. Now here you can account for any equipment you're going to buy. So this is where you're going to want to keep track of trucks or how many you have over time, and you can look on your annual detail up here to see total truck, and you can assume one truck per plumber. So in this case, by year 10, you've got 200 almost. So your CapEx schedule for vehicles should match that schedule. And you could group vehicles together and do just as long as the cost basis is accounting for all the vehicles, useful life, and the month you're purchasing them. And then that's all you got to fill out on here. Startup costs, these are one-time fees, maybe web design, consulting, reserve, anything that's not depreciable, but you need to account for in your cash flow that you're expending. That's not accounted for elsewhere. Terminal value here is pretty simple. It's just showing the end month, year end, the trailing 12 months EBITDA, the multiple, the total value of that. Then we've got the percentage applied to any fixed income or fixed assets. Now this could be relevant if you've got a whole bunch of trucks relative to the sales price. So basically anything less than 100% is going to apply to fixed assets. And that's where you see this number here, value at sale, and these are all fully depreciated, basically everything except for the first one here. But if we were, let's say, let's put these a little bit later and extend the useful life. Let's say these are all 7 years, let's say 15. So see if they're still useful life, then the value at sale is going to be based on that 5% split over evenly over your fixed assets based on what's available, this number here. And then the rest is going to go to extraordinary income. And this is just a tax thing. If you don't even want to account for taxes, you can just set this at 100% and then it won't matter. Okay, we'll keep going here. Debt schedule. This is just if you're going to fund anything with like an SBA loan, you can put that, the amount on the global control tab, the traditional funding, and then that will flow into here, and you can set the terms on this tab, interest rate, annual, years, payments per year, and first payment date. Inventory. So this is all of those materials that we're using to complete the job will have an inventory basis, and we're going to assume that you can buy those ahead of time, and then this month input is how much you're buying ahead of time. So like every 5 months, if I put 5 here, you're buying for the next 5 months, every 5 months. Now we have the income statement. So here's all your service revenue, your cost of goods sold, which is that inventory amount we just talked about, gross profit, operating expenses, EBITDA, interest, depreciation, and then exit value stuff here, taxable income, and net income. You can see these items here on the exit value are accounted for. And if you zero it out, then there would just be no tax. Annual income statement, same deal, but on an annual basis. Balance sheet, here you're going to see cash and inventory of your fixed assets, accumulated depreciation, total assets, long-term debt, common stock for outside and insiders, retained earnings, and then obviously total assets equals liabilities plus owner's equity. So here we're all matched up and balanced, and this should always be balanced as long as you're just changing the cells in yellow. Balance sheet annual, same thing, but on an annual basis here. Cash flow, you've got operating activities, investing activities, financing activities, and all the cash flow for each of those sections. Cumulative cash flow, this will inform the balance sheet cash balance. Cash flow annual, same deal, but on an annual basis. Then we got some cool visualizations. So annual revenue, annual EBITDA, annual job count, free cash flow, annual revenue by service tier, annual job count by service tier. So how many jobs are completed each year. Total gross profit per job by service tier. And this is total gross profit for each year. Annual revenue, average gross profit per job. This title needs updated. This is just total gross profit per year by service tier. And then average gross profit per job. So this is how much you're making per job each year on average. Total plumber count, truck count over time. Average hours of work per month per plumber. So again, another good metric to see if your assumptions are realistic. And then average monthly earnings per plumber, truck by tier. And again, this is another just a sanity check to make sure your assumptions are making sense and congruent with your strategy. Alrighty, then executive summary. We've got revenue by the different service tiers, cost of goods sold, gross profit, your fixed costs, total expenses, EBITDA, debt service coverage ratio, other cash flow items. So this allows you to see an annual summary of everything down to cash flow, cash position, and then this checks out with the annual detail as well. And you've got some return summaries here, IRR, ROI, equity multiple for the project as a whole and for the investor group and owner group. Go to distributions. This is basically discounted cash flow analysis showing the total upfront equity required and then the returns on that over time. And again, that's matched up with the annual detail cash flow to sanity to check the numbers. You've got IRR, discount rate, net present value for the project. Then you've got the same thing for the investor group and owner group. Monthly detail. So here's where you can see all the assumptions coming together. for job count, revenue, head count, hours worked, average hours per plumber, expenses, wages, payroll taxes, variable costs, gross profit per tier, average gross profit per tier. Sorry, variable costs are down here. Variable costs per total headcount truck, monthly insurance, maintenance, total overhead, gross profit after other overhead. So this is kind of a nice number to see before your fixed expenses, how much are you generating in cash. Then you got your fixed expenses, EBITDA, other cash flow items, and then total cash flow. And this really lets you see on a detailed level how all the assumptions are coming together to give you a pro forma. Annual summary, same thing as a monthly, but an annual basis. And that completes the review of the model. Hopefully, if you're looking to plan out the financials of a plumbing business and want to test different things, this is a very good comprehensive model that gives you the right revenue assumption logic to make proper forecasts and test out the unit economics of this type of business. All right, that's all I got for you to buy it. It'll be a $45 one-time fee. Link is in the description box below. Also, I'll put it up on other vendor sites, and have a good one.